AMC is right now at a critical turning point. It's trading at all-time lows, short interest is rising, and the retail investors are becoming more optimistic. But the big question is there a massive comeback around the corner? Could there be a massive short squeeze? Or is this a potential warning for bankruptcy? In this stock analysis video, we're going to find the truth. So buckle up and let's dive right in. We're now looking at the charts on TradingView of AMC, and we're looking at daily candles, and we can see it's trading right now at $2.22. And we can see that recently on November 21, we had like a bullish engulfing pattern. This indicates that there might be a good probability that the prices will climb higher. And we can also see that it was very oversold here on the RSI because it went all the way down. And a lot of times it just bounces back at least to the moving average. So based on technicals, it looks oversold and a good buying opportunity. But could there be a short squeeze, or is this company doomed for bankruptcy? Let's find out. So let's do a quick fundamental overview. But first we need to know that AMC is a meme stock, and a meme stock is usually a company that is struggling financially and it's almost bankrupt. And that's also why the price is so low at only $2.20. That's you're risking small to make big. That's essentially how you have to see these kind of meme stocks. Let's look here at the financials. We can see that the financial strength is pretty bad because they have a lot of debt compared to cash, and they try to fix it through printing shares, and that causes dilution. And their profitability rank is 3 out of 10, which is not that bad. And you can see that the gross profit margins are pretty good. They have actually really good margins on like popcorn, like the food and the beverages, which is interesting. So we can see here the debt that is extremely high. And we can see in the last, like during the pandemic, of course, everything went down. And now you see that the revenue is climbing, which is great. And here we can see the income statement. And we can see that the gross profit is 66.7% and the net income is minus 352 million. Total operating expenses are extremely high, and there they have to cut costs on, and that could lead to a potentially better future for this company. So we're now looking here on Finviz, and we can see that the price to sales ratio is 0.23, which is extremely low. And that shows that the revenue is actually pretty high compared to the market cap, which is great. It's also pretty good against the competition. So if we look at IMAX, for example, or Lionsgate Studios, you can see that the price to sales ratio is much higher than 0.3. So very low multiple, paying 25 to 30 cents for each dollar of revenue, which is considered cheap. So what is an economic moat? An economic moat refers to a long-term competitive advantage that a company holds that protects its position in a marketplace. So a company with a strong economic moat is resistant against competition and will do well over time. So let's find out about AMC. So here we can see whether AMC has a strong economic moat. So let's type in AMC. We can analyze it, and we can see that it doesn't have a moat. It's a 1 out of 10, which is not really good. So AMC has no durable competitive advantage, operating in a highly competitive and capital-intensive industry with long-term structural headwinds. And the overall moat score is pretty low, a little bit of switching cost, intangible assets and efficient scale, but zero network effects and zero cost advantages. And here we can see the total strength and risks of this company. So it's a large global theater footprint, one of the largest in America. And it's a strong brand recognition, also because it's now a meme stock. So you do have the mass psychology behind you. And there's high traffic during blockbuster releases and high retail investor engagement. That's good. What's also good is that they make a lot of money on the drinks and the popcorn. And the risks, it's extremely high debt burden, long-term decline in theater attendance, competition from streaming platforms like Netflix, for example, thin margins and high operating costs, and frequent dilution to raise capital. This is also an issue because that makes the shares less valuable by creating more shares of it. And a potential bankruptcy risk if refinancing fails. So what's the probability of a bankruptcy and how long can this company survive? Well, we can use the cash runway. So what's the cash runway? The cash runway measures the implied amount of time that an early stage startup can continue operating at a loss before depleting its cash on hand. And with an early stage startup is a lot of times a company that doesn't make money. So you can also put it for AMC, which is also making negative net income. They're not profitable. So how long can they survive with their current cash flow? On this cash runway calculator, I filled in the total cash on hand. I found all the information on TradingView. You can also find it on Yahoo Finance or other financial websites. And I put the net burn, which I use the cash flow from operations, which is negative, but you just put here the number, which is 81 million. And the period length is 12 months because I use the TTM, which is the last 12 months. And then we can see that it can survive for 61.8 months, which is roughly 5 years. So this company is not going to go bankrupt anytime soon. So they still have a lot of time to become more profitable in the future. A lot of retail investors are wondering whether there could be a potential short squeeze. And in order to have a short squeeze, we need a high short interest and a lot of days for the short sellers to cover. And we need a good news catalyst. Well, if we look here, the short interest is 49 million shares and it takes 2.33 days to cover, which means that it takes for all the short sellers to buy back all the shares is 2 days, 2.33 days, it's a good time. The short interest float, percentage float is 10.66%, which is not like super high, but high enough to create like a small short squeeze. But we need, in order for the price to really go up high, we needed to combine a short squeeze with a lot of hype and momentum. And that's the only way this stock can really fly higher. We're now looking here on StockTwits and we can see that the sentiment is neutral, message volume is neutral, and the participation ratio is low. So could this be the calm before the storm? Well, if we look here in the feed, there was also a recent poll on which of the meme stocks people have the most faith in. And we can see that AMC is not the highest at the moment, but it's also not too negative. AMC is now trading at $2.19, and this company is not the strongest fundamental company, and it's not going to be the next big innovator. But because it's so low, the analysts on TradingView still are pretty positive. They look at this 1 year forecast, they think it will be higher than the current price, and a maximum of 100% and minimum of 4.78%. So the technical setup looks pretty good. It's pretty oversold right now. And a lot of time you see that the price bounces back to the moving averages. There's also a lot of risk with this company because the economic moat is not that strong and their fundamentals aren't really strong. But they do have like still a long cash runway, so I don't think this is going to go bankrupt yet. So I see this as a high risk, high reward play. If there is a short squeeze, if the hype comes back, then you can make a lot of money in this stock. But if it keeps continuing with the downtrend, you can lose also a lot of money. Because it's high risk, high reward, I will personally only allocate a very small percentage of my portfolio because of the high risk involved in this company. Of course, always do your own research, your own due diligence. If you like this kind of content, feel free to like and subscribe, and I'll see you in the next video.